Told you not to sell.
I worry about it a good.
Hex.com.
Do you happen to own index funds in your portfolio? Maybe SPY from State Street, or VOO from Vanguard, or IVV from BlackRock?
Is now the right time to invest in index funds, even in today's overpriced market? With stock prices at record highs and concerns about market volatility, many investors are wondering if index funds remain a smart, safe choice. Before we dive in, picture the stock market as a roller coaster. There are thrilling climbs and nerve-wracking drops, but you're not sure when the next one will come. Index funds, though, act like the safety rails, keeping you on a more stable path throughout the ride. While you may experience bumps along the way, index funds are designed to help you stay in the game for the long term, no matter what the market does in the short term. But what exactly are index funds? Let's break it down. An index fund is a type of investment fund that tries to match the performance of a specific index like the S&P 500 or NASDAQ. Instead of trying to pick individual stocks or beat the market, an index fund buys a little bit of every company in the index. For example, when you invest in an S&P 500 index fund, you're investing in 500 of the biggest companies in the US like Apple, Microsoft, and Amazon. This gives you broad exposure to a variety of companies, which can help reduce your risk. One reason index funds are so popular is because they're easy to understand and manage. You don't have to worry about picking the right stocks or deciding when to buy or sell. The fund does that for you, and since it's simply tracking the performance of an index, the fees are usually much lower than those of actively managed funds where managers are trying to outsmart the market. Lower fees means more of your money stays invested and can grow over time. Now let's talk about why some people are hesitant to invest right now. It's no secret that the stock market looks expensive. The Shiller price to earnings, or PE ratio, which measures how much people are willing to pay for a company's earnings, is around 35. That's high compared to the historic average, which is closer to 16 or 17. After the 2008 financial crisis, for example, the PE ratio dropped to around 14 because people were more cautious. So you might be wondering, are today's stock prices too high to justify investing? It's a fair question, especially when we think back to past market bubbles. Remember the dot-com bubble in the early 2000s? Tech stocks were overvalued, and when the bubble burst, many investors lost a lot of money, at least in the short term. The same thing happened in 2008 when the housing market collapse sent stocks tumbling. Given the market's high valuations today, it's natural to be concerned about the possibility of another correction or even a crash. But here's the thing actually, trying to predict when the market will crash, or quote, timing the market, is extremely difficult even for professional investors. In fact, most people who try to time the market end up missing out on gains instead of avoiding losses. The stock market might be high today, but it could stay high for a while before any correction happens, or it might keep going higher. There's no way to know for sure, and waiting for the perfect time to invest can lead to missed opportunities. So what's the alternative here? One popular strategy that works well with index funds is called dollar cost averaging, or DCA. Instead of putting a large chunk of money into the market all at once, you can invest a fixed amount of money at regular intervals, say $100 every month, regardless of whether the market is up or down. This way, you spread out your risk. When the market is high, your $100 buys fewer shares, but when the market dips, your $100 buys more shares. Over time, this averages out your purchase price and helps you avoid the risk of buying everything at the peak. Dollar cost averaging works particularly well with index funds because of their long-term nature. You're not trying to time the market with quick trades or guess when prices will drop. Instead, you're investing steadily no matter what the market is doing and letting time work in your favor. This strategy helps reduce the emotional stress of investing. No more worrying about whether you should buy now or wait for a dip. You should just stick to your plan and keep investing at regular intervals. But what if the market does crash after you invest? Isn't that a big risk? It's true that market downturns can be scary, especially if you're new to investing. However, history has shown that the stock market tends to recover from crashes over time. While you might experience losses in the short term, if you hold on to your investments and keep adding to them during the downturn, you'll likely see those losses turn into gains once the market recovers. In fact, many of the best opportunities for long-term growth happen when the market is down. When prices are lower, you can buy more shares for the same amount of money, and as the market recovers, the value of those shares goes up. This is why sticking to your investment plan during both the highs and the lows is so important. The key is to think long-term and not get too caught up in the short-term fluctuations of the market. Now let's take a quick look at the historical performance of index funds. The S&P 500, for example, has returned an average of around 10% per year since it was first introduced in 1957. That includes periods of high valuations, market crashes, and everything in between. Even if you had invested at the very top of the market right before a crash, like in 2007 before the financial crisis, if you had held on to your investment and kept adding to it regularly, you would still have seen significant gains over the following decade. But what happens if you really can't shake the feeling that the market is overpriced? You might be worried about putting all your money in at once, and that's completely understandable. One thing you can consider is diversifying not only across different companies and sectors, but also globally. For example, while US markets might feel overheated, there are index funds that track international markets or emerging economies that could offer more reasonable valuations. Spreading your investments around the world can reduce the risk of being too reliant on one region's market performance. Of course, investing in the stock market always carries some level of risk, but one of the biggest benefits of index funds is their built-in diversification. By investing in hundreds of companies at once, you're spreading out your risk across different sectors and industries. This reduces the impact that any one company or industry's poor performance can have on your overall portfolio. Even if some companies in the index struggle, others will likely do well, helping to balance things out. Another thing to consider is the long-term power of compounding. When you invest in an index fund, you're not just earning returns on your original investment, you're also earning returns on the returns you've already made. Over time, this compounding effect can significantly boost your wealth. The earlier you start investing, the more time your money has to grow thanks to compounding. Now you might be wondering, is there a bad time to invest in index funds? While the market might look expensive right now, history shows that consistently investing over time rather than trying to time the market tends to produce better results. So if you're ready to start investing but worried about the current market conditions, remember, it's not about timing the market, it's about time in the market. Stay patient, stay disciplined, and let your investments grow over the long haul. If you enjoyed this video, do be sure to like, subscribe, and hit the notification bell so you don't miss any of our latest updates going forward. Do let us know your thoughts in the comments section, and we'll see you guys in another video.